In the second video on interest rates and valuation, we'll continue talking a little bit about some bond characteristics, but then we'll work our way into determining or looking at the techniques for calculating the value of bonds. So, first of all, let's assume we think about bond prices in general, right? If you look in the newspaper and try to figure out what a bond's price is, they're quoted in some fairly strange mechanisms, I guess you will. But essentially what happens is bond prices are typically issued as a percentage of par. So if you look down here at Verizon, the price is 91.98. That is really saying that Verizon is selling at 91.98% of its par value. And par value is always $1,000. So this bond would sell for $919.80. You just move the decimal place 1 point. Just because it just saves a little bit of time, obviously, in some decimal places. We find that some government securities are actually quoted somewhat differently, but in general, it's always as a percentage of par. So if you think about bond ratings, right, how are bonds actually, this system of analysis, how does it work? So what happens is there are companies, in this case we have two of them listed, Moody's and Standard & Poor's, and they do a financial analysis of the company. And from that, they categorize them or put them in priority from the least risky to the most risky. So in this case, for Standard & Poor's, a AAA rated bond is what's referred to as prime quality. That is, it has the highest quality, which means it is the safest of all the bonds. And as you go down the list, these bonds become more and more risky. And in fact, when you get down to C and D, these bonds might actually be already in default or very close. So these are very risky, and these up here are less risky. So let's think about returns. If these are less risky, what is also probably true about their returns? Less risky should also have lower returns. So these bonds up here will have lower returns than these bonds down here. So since they have lower returns, they're also going to have higher prices. So these bonds will hover very closely around the $1,000 mark, and these bonds down here may have some fairly substantial discounts. So let's continue on talking about some bond characteristics. Bonds can be classified generally as being unsecured or secured. Unsecured debt, sometimes referred to as junior debt, the term that we typically use is a debenture. And a debenture is nothing more than an unsecured debt. What that means is that a corporation essentially signs its name and promises to pay. So the difference between that and secured debt is secured debt has collateral. So a mortgage bond is a bond that actually has as collateral the real estate for which the bond was used to purchase. So if you think about the scheme of how debt gets paid off, say a company goes bankrupt, senior debt will be paid first because the assets, the collateral will be sold, and then that cash will be used to pay off those loans. Then, if all those get paid off, the next thing that gets paid is the junior debt. Now, government bonds, certainly, obviously, the government issues lots of debt. We could have federal bonds and we could have municipal bonds. And without getting into a lot of detail, you just need to know that there are several different types of government debt that is available for investors. International debt, I have a spelling error here. International debt can be categorized based on the type of currency that's used for the debt. So what we ultimately have then is we have what's referred to as a Yankee bond. This is a bond that's issued by a foreign borrower. It's issued in dollars, but it also it has trading on the U.S. exchanges. So therefore, it's regulated by the SEC. A euro bond is a bond issued by an international borrower, sold to investors in countries with currencies other than the currency in which the bond was denominated. However, these are not regulated by the SEC, or do they trade in the United States. So these euro bonds typically trade in dollars, but they're not regulated by the SEC. They don't trade on U.S. Markets. Foreign bonds is a bond that's issued by a host country's financial market. So it is a host country's currency, and obviously it's a foreign borrower. And bond markets give opportunities, right, to maintain large amounts of long-term debt very quickly, right? And it could be in their currency of choice. And there's also some flexibility in repayment terms. So international debt is out there, it's available. Relative to the domestic, United States domestic debt, it's a rather small part of the securities that are available for investing. So let's move on to talk about valuation and how this works. So the valuation process works with all assets. So valuation is the process that links risk and return to determine what the worth of an asset is. So ultimately, we want to find out what is the maximum you'd want to pay to buy this asset. In this case, we're talking about bonds. And there are three key inputs we need. We need to know what the cash flows are. We need to know when the cash flows occur. So we need to know the magnitude and the timing of the cash flows. And we also need to measure a measure of risk. So the cash flows and timing will help us understand when the cash flows occur. The required return, which incorporates risk, is going to help us with the time value process of determining the current value of these predicted future cash flows. So we want to find the value of any asset. It's the present value of all of the future cash flows. So the R here in this formula is the discount rate or the required return. Now remember that this discount rate, this required return for bonds, essentially is going to be tied to the riskiness of the bonds. So all AAA rated bonds will typically have a very similar required return, if not identical required return. So our basic investment rules, and this goes across the board for any investment, says if the value of an asset is greater than or equal to its price, you would be willing to buy the asset. Now we know what the price is, so our task as investors is to try to figure out what is the value of the bond. An additional way to look at this is look at percentages. If the expected return is greater than or equal to the required return, we would be willing to buy the asset. So the expected return says, look, we know what the price is, we know what cash flows we expect to receive, and when we expect to receive them. So let's solve for the return on that investment. So this is the expected return, what you think you'll get if you buy it and hold it. When we talk about bonds, this has a special name. It's called yield to maturity. It's the yield return you get if you buy at today's price and the cash flows actually occur. Now we want to compare that to the required return of the asset, and that obviously incorporates risk. And we've talked about this several times. So here is an example of some information from Molson Coors. Molson Coors has a bond. The maturity is 2042. So how many years is that until this bond matures? 2042 minus 2018, that should be 24 years. It has a 5% coupon. It is callable. The rating for Coors debt is BBB minus. So it's not the highest quality. It's down in quality a little bit. The current price is 102.008. So that means this bond is going to be selling for $1,020.08. And the current yield, if you pay that price and you hold it to maturity, you would earn on average 4.856% on this investment. So again, how many years? It's 2042 minus 18, or 2018, essentially gives us 24 years. Annual interest payment is $50 a year, 5% of 1,000. How many coupon payments are there? Well, if there's 24 years, if we're talking once a year, that means there are 24 payments. But if there are semi-annual payments, then we may have to do that twice a year, so that would make 48 payments. We already talked about the current price, and obviously the yield to maturity is the 4.856%. What I would suggest maybe is you take a look at the company that you're following and find a piece of their debt. Find out one of their bonds. And you do this. There was a website we talked about a little bit earlier. It's called finra.org. And if you go to that website, scroll to the bottom, there's a place to put in a ticker symbol. You have to click on corporation so that it knows you're looking for corporate debt, and your debt of your company will come up. And we'll talk about this in class. If you want to understand a little bit about rates, right, then you can go to this website. It's the St. Louis Federal Reserve. If you click on this, and if you, in the search button, if you Google the rating, in this case, if you Google a BBB rating, then you will get obviously all the sites at the Federal Reserve that have BBB in them, but you're looking for the effective yield on a BBB rated bond, and that will help you identify what the required return should be. So here's a debt. We have $1,000 par value, 5%'s the coupon. We found out here that the required return should be about 4.37%. 24 is the time to maturity in years, and the compounding frequency is twice a year. The current price is $1,020.08. So the current yield that we calculate, we'll talk about these here in a second, is 4.9%, and the book value, $1,093.08. So would you pay $1,020 to get $1,093? I think, of course, you would. And if you did that, the yield to maturity, you would actually earn 4.86%, but required is what you required was 4.37. So this sounds like maybe a good bond issue. We'll also do some exercises in class with playing some of these numbers, but you can find your debt at finra.com, plug your numbers in here, and it will give you, again, the answers that you want to the kinds of yields or returns you can get on a bond investment. So just to further clarify, right, there are three basic yields that we're interested in. The current yield is the coupon divided by the market price. This tells us the rate of return you will get if you buy the bond today and you get the coupon for this year. So it's a 1-year return on this investment. The yield to maturity talks about the yield you will earn from now till maturity. So in a 30-year investment, you obviously get the first year's return, but you are also going to get an average rate of return every year that you own this investment. So this is the rate of return if you purchase and hold to maturity. The yield to call, we talked about the call provision. This just tells us what return would you earn if you bought today and you went to the very first day that a call was possible. So let's talk about bond price behavior before we get into some examples. In practice, the value of a bond is rarely equal to its par value. When a bond is first issued, the corporation tries to issue it with a coupon that is as close to the required return as they can, so that the value that they receive equals $1,000. Now, what happens after the issue date? The coupon doesn't change, but interest rates change. The company's risk changes. So we find that the required return can change from year to year, and this will cause the price to change and go up and down from where it originally started. So there may be times in a bond's life that it is above the par value, and then there may be times in its life where it is actually below par value. So interest rate risk refers to the chance that interest rates are going to change and thereby change the required return and the bond value. So rising interest rates will result in decreasing bond values, and this is obviously of greatest concern to you and I because our wealth is obviously tied to the value of our securities. Now what we'll find is the shorter the amount of time to maturity, the less responsive bonds are to changes in interest rates. So prices will not change as dramatically when we think about interest rate changes with a short time frame compared to a long time frame. So let's look at a set of bonds here. Our very first bond has a coupon of 12%, the required return is 10, and it has 10 years to go in life. The question is, what is the value of this bond? And if you do the formula, here it is, it's 1122. And of course here you can see that that's true. The bond value, according to the worksheet, which is the bond valuation worksheet, is indeed 1122. Now we find out that if you pay 1122 for this bond, you're also going to receive essentially 10.0%. So if whatever the value is, if that's the price, we'll find that the required return and the yield to maturity are the same. Now what happens if we have a different coupon? In this case, what happens if the coupon is 8%? The coupon is 8%, the corresponding value would be 877. And again, if that was the price, the yield to maturity would also be 10%. So let's think about this in perspective of investing, right? Both of these bonds are good investments because you would receive the exact return that you wanted. Now, what happens to bonds over time? So before we go to that next picture, let's kind of take a step back. If the bond has a value or a price that's greater than its par value, we say that it's selling at a premium. If the price is less than $1,000, we say it's selling at a discount. Now, as far as terminology, that's obviously the correct way to describe the bonds. However, the word premium and discount do not have anything to do with a good investment or a bad investment. It is just a description of where the price is relative to the par value of the debt. But what happens with bonds is once you buy a bond, what is it going to be worth when it matures? So if you bought this bond for $877, eventually it's going to be worth $1,000. And in this case, you're going to get interest income every year, and you also get capital gains. However, what about the other bond? If you buy that bond, eventually it's going to be worth $1,000. So again, you get interest every year, which is positive, but you're guaranteed to get a capital loss. Now, the reason for this is the reason why people buy bonds. People do not buy bonds to watch the prices rise like they do with stocks. People buy bonds for the cash flows, and those bonds that sell at premiums will typically have higher than average interest or coupon payments than otherwise bonds that sell at discounts. So they have greater cash flows. That's what people want. So people are willing to pay a higher price to receive that extra cash. So again, that is the end of this video on bond valuation.